Okay, next is marginal versus absorption costing. But before we compare both, let's focus on marginal costing. Remember, marginal costing doesn't have fixed costs included into units. Now, it doesn't mean that according to marginal costing, we don't record fixed cost, and according to absorption costing, we record fixed cost. So the accounting aspect is different. Cost has to be recorded, whether it's absorption costing or whether it is marginal costing. The treatment is just different. Obviously, because we are not including fixed costs in our units, we don't have those steps that we had in absorption costing about allocation, apportionment, and reapportionment, because there is no point. And because of not including fixed costs in units, marginal costing is very good for decision making, because we are focusing on incremental costs or additional costs. But because F2 doesn't have decision-making topics, you will understand that in F5. So remember, in marginal costing, units only include variable cost or marginal cost. It doesn't mean we charge variable cost. What we charge is something there is another topic that is called pricing. So it doesn't have to be whatever the cost of a product is. There are some things you need to know about marginal costing before we compare both absorption and marginal costing. They have not specifically mentioned in F2, but this is assumed knowledge for F2, and when you go to F5 and CVP analysis, you will see a lot of these things. I will add a link to that topic, CVP analysis of F5, if you want to know about it more in details. But at this F2 level is not important. So I will explain some of the terms. Remember, marginal cost is the variable cost of a product. Marginal means incremental. And full cost is according to absorption costing, which means including fixed cost as well. Full simply means every cost. Next we have contribution, which is sales minus variable cost. If you take sales and minus full cost, that gives you profit, because profit means that every cost has been deducted. But contribution is not profit. Contribution is very important in decision-making topics you will see in F5. So very important information. It is like a profit, but fixed cost has not yet been deducted. So it is like contributory factor to profit. It is not profit by itself. It depends on how many units we sell. Then we know whether we make profit or not. So same like profit, but only minusing variable cost or not deducting fixed cost. Or if you take profit, you add back the fixed cost per unit, that will give you contribution. Next we have break-even point. Break-even point is the point in sales. It can be sales units, it can be sales revenue. We call it break-even point in units, break-even point in revenue. But generally, break-even point is the point in sales where there is no profit, no loss. So if we want to know how many units we need to sell in order to have no profit, no loss, is break-even point. Just like I said, contribution is not profit by itself. It depends on how many units we sell. Then we would know whether we have made profit or not. So if we want to know the point in units or in revenue, where there will be no profit, no loss is break-even point. Above that point will be profit, below that point would be loss. Next we have margin of safety. Margin of safety is like saying how much safer we are from making loss. The difference, how far are we from making loss? It is the difference between break-even point and budgeted units. For example, if our budgeted units are 2,000 and our break-even point is 1,600 units, it means our margin of safety is 400. It can be calculated as a percentage, it can be calculated as units or as revenue. But the higher the margin of safety, the better it is, the less sensitive it is. When you study sensitivity analysis, you don't have that in F2 level. When you study sensitivity analysis in risk and uncertainty chapter, you will know margin of safety shows the sensitivity of units. Okay, I have a question here to help and explain these points above. So required find break-even point and margin of safety. We have product X, Y, Z. For example, the selling price is 30, marginal material cost is 10, labor cost is 5, variable overheads is $3, and fixed overheads is 10,000. And budgeted sales is 900. Now fixed cost, remember we don't have to find per unit because this is not absorption costing, this is marginal costing, so we will leave it as it is. So let's look at each of these points. First, contribution. Contribution is sales minus variable cost, which is 10 plus 5 plus 3, which gives us 12. So this is our contribution. So this $12 contributes towards earning profit. It is not profit by itself. And remember, we should have contribution. If we are selling something even at less than the variable cost, so it definitely means we will not make any profits. Next is break-even point. So break-even point has a formula. You don't have to memorize formulas. For those things that make sense, just understand them. I never recommend memorizing formulas. So it is fixed cost divided by units. Which units? Sales units. Remember, now we are talking about profit. So if we produce units and we don't sell them, we don't make profit. So fixed cost is 10,000 divided by the break-even point contribution per unit. It gives us 833.33 units, or if we round it off, 833 units. What it means is that if we sell 833 units, we make no profit, no loss. Obviously, I rounded that off, but let's prove it. Let's see whether it is actually true or not. So if I take contribution per unit of 12 and multiply by 833.33 units, if I round this off, then it becomes a total contribution of 10,000. If I minus fixed cost from it, it gives me no profit, no loss. Next, this is contribution in units. Break-even point in units. We can have break-even point in sales revenue as well. You can convert this to percentage as well. You just simply take the break-even units divided by budgeted units, multiply by 100. It will give you 92%. But it's not common to calculate it as a percentage. We have in sales revenue, For sales revenue, we take the same fixed cost divided by CS ratio, contribution to sales ratio. CS ratio which simply means contribution divided by sales. If you write it like this, then you will always remember what it is. So contribution is 12, sales is 30. So we have a CS ratio of 40 or 40%. What it means is that 40% of our sales is contribution. Now if we take the fixed cost divided by CS ratio of 40%, we have 25,000 sales revenue. If we have sales revenue of 25,000, or if we sell 833 units, then we will have no profit, no loss. Remember, if other things don't change, if material costs or labor costs or any other factor is changing, then it means that it would not be true. And if I take the sales units and multiply by the sales price, which is 30, should give me exact same thing, 25,000. So both of them should be matching. If break-even point in units gives you one thing and break-even point in sales revenue gives you another thing, it means your calculation might not be correct. What I mean is if you take the units, multiply with the sales price, it should give you the same thing. But this is a kind of direct way of doing it. So let's see whether, yeah, I've already proved that here. So if you take 833.33, it gives you 25,000 revenue. But let's do it separately so that you understand. We have sales of 833.33 multiplied by 30. So let's round it off, no matter how many threes I add. 25,000, and then let's minus variable cost, which is 833. I'm rounding it off anyway, so it doesn't matter. I've 10,518. So if I minus this from the top, rounding off 15,000, it gives me contribution of 10,000. The same thing. So if we minus fixed cost from it, we have no profit, no loss. So break-even point in sales revenue or break-even point in sales units is basically the same thing. One shows it in units, another shows it in revenue. You don't have to remember the formula. It simply means that how many units we need to sell in order to have no profit or no loss, which means we have to cover fixed costs. If we want to make profit from sales, after the variable cost, we have contribution. The next thing to cover would be fixed costs. So we take the fixed cost and divide by contribution per unit. It will give us how many units. So simple as that, nothing complicated about it. Let's look at margin of safety. So margin of safety tells us how much safer we are from making loss. Our budgeted sales, so the formula is, you don't have to remember the formula, just understand what it means. We have budgeted sales minus break-even sales. Simple as that. Budgeted sales is 900, break-even sales is 833.33. We have 67 margin of safety. What it means is that even if our sales drop by 67 units, we still have no profit, no loss. More than that would mean we have loss. We can calculate it as a percentage, which is 7.4%, which means if our sales drop by 7.4%, we will have no profit, no loss. More than 7.4% would mean we have loss. So it shows sensitivity. So the lower this percentage, the more sensitive the sales is, which means that even if If this percentage is lower, that means even a slight drop in sales would mean that there is a chance we make loss. You can calculate it in revenue as well. Our budgeted revenue, 9 multiplied by 30, is 27,000 minus the break-even sales revenue, 25,000, margin of safety in sales revenue. If I take 22,000 divided by 27,000, it gives you the same thing as above. The only difference is because of percentage. Okay, so this is more than you need for F2 level about some of the things relating to marginal costing. So you will study this in detail in F5. Now let's look at marginal costing versus absorption costing, how different profit is recorded according to marginal costing and absorption costing because of the change in inventory. Okay, I have a question here. Prepare statement of profit or loss for quarter using marginal costing and absorption costing. The following example will be used to lead you through various steps in marginal costing. Okay, Begoof Co. manufactures a single product, the bark, details of which are as follows. We have the selling price, material, labor, variable overheads. Annual fixed production overheads are budgeted to be 1.6 million, and Begoof expects to produce 1.2 million units of bark each year. Overheads are absorbed on a per unit basis. Actual overheads are 1.6 million for the year. Budgeted fixed selling costs are 320,000 per quarter. We will ignore this selling cost for this question because it will confuse you, so ignore this one. Actual sales and production units for the first quarter of 2018 are given below. Sales is 240,000 and production is 280,000. So we will prepare operating statement, which simply means statement of performance. It is like P&L for both marginal costing and absorption costing, and then we will see that both reports different profit. Okay, so on one side I have marginal costing, on another side I have absorption costing. So marginal costing is simple. Remember, the figures are in thousands. We have sales units, which is 240 multiplied by the sales price, which is 180. It will give us sales revenue, which is 43,200 if we talk in thousands. And then from this we would minus cost of sales, which is opening inventory plus production minus closing inventory. Opening inventory is not given, so I would assume it doesn't exist. Production is 280. Closing inventory we can find. If 280 is production and we sold only 240, that means our closing inventory would be 40. And I will write it that as a minus because it shouldn't be included in our cost. So simply this is transferred to next year. And then I'm going to multiply this by the variable cost. Variable cost is 40, 16, and 10. 40, 16, 10, yeah. 40 plus 16 plus 10, which becomes 66. So units multiply by the variable cost and gives us total cost variable, total variable cost. I'll write it as a minus. We don't have under or absorption in marginal costing. It directly gives us contribution. So sales minus variable cost gives us contribution, and from this we minus fixed cost. They said annual fixed overheads are budgeted to be 1.6 million, and Big Wolf expects to produce 1.2 million units of bark each year. Overheads are absorbed per unit basis. Actual overheads are also 1.6 million. Remember, we minus actual overheads here, not budgeted. So when we are preparing this statement, according to marginal costing, because these are prepared at the end of the year, they are reports, so we take the actual cost. We don't bother about budgeted cost. Okay, fixed cost is given as per year basis, but because this statement is for a quarter, I'm going to divide that by 4, so it gives me cost per quarter. So minusing 400 with a profit of $26,960. So this is simple as that. In marginal costing, we don't bother about fixed cost per unit. We just minus the variable cost, whatever the actual cost is. We minus that at the end, and that's it. Now, according to absorption costing, sales price is going to be the same. There is no confusion about the sales price. The confusion is about the cost. Now, when we are doing valuation, units, remember, will be same, whether they are sales units, whether they are opening inventory, whether they are production, whether it is closing inventory. The problem is with the cost. We use full cost. So that means we have to first find OIR, overhead absorption rate. If our total fixed cost is 1.6 million and total budgeted units is 1280, then we can find OIR. Remember, when we are finding OIR, we don't use actual units, we use budgeted units. So we have 1.25 OIR. So I can just take the variable cost plus add the fixed cost per unit, it will give me a full cost. So now here I will use full cost, 67.25. So units are same, just cost per unit is different. Adding it together, now this is full cost, and you can see here units are same, but this is more than this one because marginal costing didn't include fixed cost. So now we have to do something called under over absorption. Now this is the fixed cost we have included in units, but maybe the actual fixed cost, because we are preparing this statement at the end of the year, maybe the actual fixed cost is more or less than the one that we have added. For that, we will do under over absorption. Actual overheads are the same, 1.6 million, which means 400 per quarter. But how much did we absorb? Absorb is based on production units, remember, not sales units. If you forgot that, go back to absorption costing. So we have 280 units. So we take 280 units, multiply by 1.25, it gives us 350. So we have under absorbed of 50. And the main reason for that is if we take 280 multiply by 4 quarters, it gives us 1120 units. And our budget was 1280 units for the whole year. So because our units are less than the budget, that's why we have under absorption. Under absorption means that we have charged less cost and we have to add the one that we haven't added. So now it becomes complete full cost, including under absorption. Obviously, in absorption cost, in marginal absorption costing, we don't have contribution. We've already minus fixed costs. It directly gives us profit. And the profit is 27,010. It is more than marginal costing. And why does that happen? The only reason that it happens is because of the change in inventory. If we look at opening inventory and closing inventory in this question, we had 40 closing and opening 0, so we have 40 inventory difference, and OIR is 1.25. so if we take the inventory difference multiply by OIR, it will give us profit difference of 50. And if I look here, we have a profit difference of 50, which means absorption costing has 50 more profit. Now this difference is not going to be forever. So the difference is because of the increase and decrease in closing inventory, because in absorption costing, some cost is transferred to next year. You can see here, this is 26.40 and this is 26.90. So there is a $50 difference. That $50 is transferred to next year. So the result would be next year's profit would be less. So it is only a timing difference. It doesn't mean that if you are using marginal costing, your profit will always be less. They will be only less when your closing inventory is more. If your opening inventory is more, then marginal costing will give you higher profit. So we will look at the same example now, exact same thing, but we will assume that there was opening inventory 50 units and closing inventory was 40 and production was same 280. If opening is 50, production is 280 and closing inventory is 40, how many units would we have sold? Which would be 280 plus 50 minus 40. So from this figure we have to find how much is sales. So we have opening plus what we have produced minus what we have remaining. That means our sales unit would be 290. Now I'm going to just copy this because everything is already linked. It will save time. Just double checking. Yeah. Now we have 19,400 variable cost. We have a contribution of 33,060 minusing the fixed cost. We have a profit of 32,660. If we look at the same thing according to marginal costing, absorption costing, let me link it. Okay. Okay, we have to find under OR absorption. Remember this time as well, our production is 280, so under OR absorption is exact same. So we have to add the under absorbed to the fixed cost. Now if we see marginal costing gives us higher profit. How much? 12.5. And if you see, it is because closing inventory is 40, opening is 50. So we have 10 difference, and OIR is 1.25. If you multiply that, it gives us profit difference. So now because the closing inventory is less, and if we look here, yeah, in closing inventory, cost is transferred to next year, 50 more, but from last year's opening and closing inventory, more cost is brought to this year. If you see here, it is 3,300 and it is 3362.5. So 62.5 is more is coming and 50 more is going. If you look at the difference of that, it becomes 12.5. Now let's assume that there is no opening inventory and there is no closing inventory, that means we sold as many units as we produced. In that case, $280 is sales and $280 is production. We have $31,520 profit. If we look at it according to absorption costing, under our absorption edit, should give us full cost and directly profit. And you can see it is exact same thing. So if our opening and closing inventory is the same, marginal costing and absorption costing will give us the same result. So that profit difference is temporary, and it is because of the change in inventory. Okay, so we had three situations. When opening and closing inventory is the same, marginal absorption will give you the same result. When opening inventory is more than closing, marginal profit will be more than absorption. When opening inventory is less than closing, marginal costing profit would be less than absorption. You could say opening inventory favors absorption, marginal costing, and closing inventory favors absorption. Opening inventory favors marginal costing, closing inventory favors absorption costing. So remember it like this. If closing inventory is more, that means that absorption cost per unit transferred to next year would be more than the opening, because of which this year's profit would be less. And the resulting effect of that would be that the cost that is transferred to next year will make the profit of next year lower, unless the closing inventory is further higher than the opening inventory. Now let's look at questions which is simply calculating profit using absorption costing and marginal costing. Remember, the only reason the profit is different is because of the units opening and closing inventory. Okay, let's look at kit questions comparing absorption costing and marginal costing. Almost all questions are basically calculating absorption costing from marginal costing, calculating marginal costing from absorption costing, or finding the difference of profit. Okay, what would be the profit for the period 9 using marginal costing? The following data is available for period 9. We have opening inventory, closing inventory, and absorption costing profit. So which one is correct? We cannot find answer using just this data, because we need at least OIR or a way to calculate OIR. We know the difference in units, which is 2000, but we have to multiply by OIR, so it is not possible in this question, so D would be correct. Compare with marginal costing profit for the period. The absorption costing profit for product T will be which of the following? The overhead absorption rate for product T is 4. Okay, it's given. Each unit of T requires 3 hours. Focus on this one. Sometimes overhead absorption rate is not given per unit. It can be given per hour. Inventories of product T last period were opening 2400 and closing 2700. So there is a difference. They said compare with marginal costing the absorption. So they're asking for absorption. Remember, absorption would be higher. If they were asking for marginal, margin would be lower. Be very focused on that. So the difference in units inventory is 300. Multiplying that by 4, but if it was per unit, but each unit requires 3 hours, that means 3600. Absorption costing profit would be 3600 more. They said the absorption profit for product T will be 3600 higher, which means D would have been the answer. Next, in a period where opening inventory is worth 15, closing worth 20, you should know before you read further that absorption would be higher. A firm had a profit of 130 using absorption, marginal would be less if the fixed overhead. So remember, it is important to know whether opening inventory is more or closing inventory is more, and also whether they're asking about absorption costing or whether they're asking about marginal costing. So if the fixed overhead absorption rate was 8 per unit, the profit using marginal would be which of the following? Remember, they're asking for marginal. Closing inventory is more, opening is less. Marginal profit would be less. If absorption is 130, it cannot be exactly 130 because there is a difference. So this cannot be the answer. 170 can also not be the answer because it is more, marginal would be less. Next one, impossible to calculate. No, we can calculate it because it is given. So the answer would be 90,000. So this is called educated guess. So let's calculate 20,000 minus 15,000. 5,000 multiplied by 8 would give us 40,000 would be less. If 130,000 is profit, if I minus that, we have 90,000 profit according to marginal costing. Next, what is the marginal costing profit for the month? Cost and selling price detail for product 0 are as follows, with material, variable overhead, fixed overheads, and then total cost and then profit. Selling price is 30. Budgeted production for the month was 5,000 units, although the company managed to produce 5,800 units, selling 5,200 of them and incurred fixed cost of 27,400. Remember, when we are calculating marginal costing profit, we don't care about fixed cost per unit. We just take the units that we sold. It doesn't matter how many units we produced. Multiplying by the contribution will give us directly a total contribution. Profit is given, but we need contribution, which is 30 minus the variable cost. Or the easiest thing to do is take profit, add back fixed cost. But because what basically is contribution is profit before fixed cost. See, if I do it both ways, it should give me same answer. But this is easier. So multiplying by 14 will give me total contribution 72,800. If our actual fixed cost is 27,400, we don't care about budgeted fixed costs. Our profit should be A. So remember, some things given here are just distractions. What is absorption costing profit? Okay, we budgeted to make 5,000 units. OIR is already given. We managed to produce 5,800. We sold 5,200. Opening inventory is not given. If there is any inventory remaining, it would mean closing inventory is higher. That means absorption costing profit should be higher than marginal costing. 45,400 is marginal. So this cannot be the answer. This can also not be the answer. So answer would be any one of these two. So we simply take the production units minus the sales unit, which will give us closing inventories if we don't have any opening. So we have, remember, closing inventory is not always found like this, but because there was no opening inventory, so obviously this is how it would be found. So we have 600 multiplied by the OIR, which is fixed cost per unit 5, 3,000 difference. 45,400 plus 3,000 gives us 48,400, which means D is correct. If the budgeted total fixed costs were, what was the budgeted level of units? In a period, company had opening inventory of 31, closing 34. It means absorption should be higher. Profit based on marginal costing, profit based on marginal was 85,500 and absorption was 95,500. Okay, so we have 95,500 minus 85,500. That means we have 10,000 profit difference. And if we look at units, 34,000 and 31,000, we have 3,000 units difference or inventory difference. If I take 10,500 divided by 3,000, it gives me OIR. Why? Because if I take unit difference multiplied by OIR, it gives me total profit difference. Likewise, if I take total profit difference divided by unit difference, it should give me OIR. They said if the budgeted fixed cost was 183, what was activity? If budgeted overheads divide by budgeted activity equals OIR, then budgeted overheads divided by budgeted OIR should give us budgeted activity, which is 183,500 divided by 35. So when you are confused in changing equation like this, you can always confirm it. Like if I take 183,500 divided by 52,500, it gives me 35 OIR. So budgeted activity is 52,500, which is B. What is the fixed overhead cost per unit? It is just like this previous question, but only up to this point. So I will leave that. Which of the following are acceptable rates? Direct labor, machine hours, percentage of prime cost per unit. Remember, all of them we studied in absorption costing. Under absorption costing, they're not saying under or absorption. Under absorption, according to absorption costing, the total cost of a product will include direct costs only, variable costs only, all direct and indirect costing, excluding share cost of fixed, all direct and indirect, all direct and indirect. The main thing about absorption costing is fixed costs are included in it. What was the profit under absorption costing? So it is very similar to the previous question, nothing new. I will leave it. How much profit is made under marginal costing if company sells to 50,000 units? A company produces and sells a single product. Variable cost is 6. Fixed cost have been absorbed over normal activity of 200. Normal means budget. Normal standard budget means the same thing. Obviously, context is different, but normally it means the same thing. And have been calculated as 2 per unit. The current selling price is 10. Remember, when they tell you that the budget is a certain thing and they don't give you what happened to the actual, then you normally assume that whatever was budget was the actual. Okay, so in this case, with selling price of 10 minus the variable cost of 6 should give us 4. Multiplying that by the units we sell to 50,000 multiplied by 4 will give us contribution of about 1 million, and we minus fixed cost from this, which is budgeted activity multiplied by OIR. Remember, this is the same formula, budgeted overheads divided by budgeted activity equals OIR. Now if we take OIR multiplied by budgeted activity, it should give us budgeted overheads. Because actual overheads is not given in this case, we would assume the budgeted and actual overheads is the same, which is 400,000 deducted from there should give you 600,000 answer. 600,000 B is the answer. What is the profit under absorption costing? So this also seems similar. I will leave it. If the company uses marginal costing principle instead of absorption for this month, what would be the effect? Again, profit would be higher or lower. So I think there's nothing new here. But let's say a company manufactures a single product. For this month, the budgeted fixed production overheads were 48,000. Budgeted production is 12,000 units, and budgeted sales is 1720. The company currently uses absorption. If company use marginal costing principles instead of absorption, what will happen? So if they use marginal costing profit will be lower. So calculate that, nothing new. What was the actual expenditure on fixed overheads last month? A company operates a standard marginal costing. Last month, its actual overhead expenditure was 10% above budget, resulting in a fixed overhead expenditure variance of 36,000. You will be able to understand this after variance analysis. But let me explain what it means. What was the actual expenditure? Last month, its actual fixed overhead was 10% above the budget, resulting in a fixed overhead expenditure of 36,000. So 30,000 was more. If 30,000 is more than this is 10%, multiply by 110 would give us what the actual is. So don't focus on it now. I just answer it for reference. You will be able to understand it after variance analysis. What would the profit for last month have been using marginal costing? Last month, when company had opening inventory of 16, closing and profit absorption, the fixed overhead. Okay, simple. Same as previous. What was last month's production in units? Last month, a manufacturing company's profit was 2,000, calculated using absorption costing principles. If marginal costing principles had been used, a loss of 3,000 would have occurred. The company's fixed cost is 2 per unit. Sales last month were 10,000 units. Okay. The profit is 2,000 according to marginal costing. If we had used this according to absorption, if marginal costing had been used, we would have reported 3,000 loss. Now it doesn't mean that 3,000 minus 2,000 we have 1,000 difference. We have 2,000 profit on one side and 3,000 loss on another side. So that means we have a 5,000 profit difference. If our OIR is 2,000, 2 per unit, we take profit difference divided by OIR will give us units difference. Last month's sales were 10,000. If sales were 10,000, that means production should be more. That's why we have more absorption costing profit. So we will add that to the sales unit. It will give us production units. Remember, there is no opening inventory in this question, so that's why you can just take the unit difference and add that to the sales. Okay, HMFCO produces a single product, and okay, same as previous. What would be the reduction in profit for period if company had used marginal costing rather than absorption costing? A company has the following budgeted cost and revenue. We have sales price, variable cost. Reduction in profit or difference in profit means the same thing. So they are specifically telling us that if we had used marginal costing, profit would be less. So it would be less. How much less? In most recent period, 2,000 units were produced, 1,000 were sold. Actual sales price, variable cost per unit, fixed production costs were all as budgeted. Fixed costs were over-absorbed by 4,000. There was no opening inventory for the period. Remember, when we were calculating profit difference of absorption and marginal costing, we didn't look at under or absorption or anything else. We just look at the difference in units and multiply by OIR. So we are going to do the same thing here, even though other information is given that is only for confusion. So we will look at difference of units. If 2,000 were produced, 1,000 was sold, it would mean 1,000 is closing. If opening is not given, that would mean 1,000 is difference. Multiply that by OIR, which is 10, we would have 10,000 difference. So marginal costing profit would be 10,000 less. Next, which of the following statements is or true? The following data is available for production and sales for the first years of company's new product. We have year 1, 2, 3, production and then sales. Variable cost per unit, sales price, and total fixed cost per unit were constant over the year. Remember, I told you that the difference in profit would be just because of difference of units multiplied by OIR. The condition is if the costs don't change. If the cost, variable cost or sales price or those things change, then that difference will be not exactly OIR. And even if they don't tell you, usually you should assume that they are constant. The company is considering using either marginal or absorption costing. Which of the following statements are true? Absorption costing will show lower profit than marginal costing in year 1. Sales is 4, production is 5, no absorption will give higher profit. Marginal costing will show lower closing inventory valuation than absorption costing in year 2. See, they said marginal costing will show lower closing inventory valuation. Closing inventory valuation is always going to be more in absorption costing. The only difference is, because of which the profit changes, is because of the opening inventory. Whether opening inventory is more or less than the closing inventory. So no matter how many units are opening or closing inventory's value is going to be higher in absorption costing. So this is wrong. Marginal costing will show lower closing inventory valuation than absorption costing in year 2. Yeah, so in year 2, marginal costing will show lower closing inventory valuation. In fact, it will do it in every year, not just year 2. Total profit over the 3-year period will be the same under both methods. That we have to see. Total profit. They didn't say per unit, yeah? They said, they didn't say per unit, they said total. So if you look at production, we have 5,000, 6,000, and 4,000. We have 15,000, and then 4,000 plus 6,000 plus 5,000 equals 15,000. Yeah, both will give you the same profit because, yeah, in first year, absorption will give you more profit. In next year, marginal will give you more profit. In next year, marginal will give you more profit as well. So in this year, we have, we have closing in units 1,000, then sales are 6,000. Opening and closing here will be the same, so profit would be same here. But here, marginal will give you more profit because sales are more than production. So overall, in both 3 years combined, the profit that is reported less, according to marginal costing, will be compensated in this year. So overall, 3 years profit would be the same. So correct is 2 and 3. Marginal costing will show a lower closing inventory valuation than absorption costing in year 2. This statement is correct, but this is not correct in a way that it is always true. If it was worded like marginal costing will give you lower closing inventory valuation in all 3 years, then it would be the same. It would be good statement. In year 2 is also correct. So 2 and 3 I would select as correct. Which of the following statements is true? Company's total operating cost is semi-variable. It flexes its profit budget from an output level of 1,000 units to an output level of 2,000, where it simply means that budget was made according to 1,000 units, but actual output were 2,000. Flexible budget, fixed budget, you will study in budgets. So what will happen? Operating profit will double between the two output levels. It says if our units become 2,000 from 1,000, our profit will become double. No, they will not become double because of the fixed costs involved. Fixed cost per unit and 2 levels will be the same. Per unit, they will not be the same per unit. They will be same in total. Remember, go back to the cost behavior and we studied fixed costs are same in total no matter whatever the activity level is, but per unit they decrease the more the units. Total contribution will double between the two output level. Remember, contribution per unit is always going to be the same. So if 1,000 units gives you 1,000 contribution, 2,000 units will give you 2,000 contributions. This is correct. Contribution per unit will increase between two. No, per unit will not increase, total will increase. So this completes marginal costing and absorption costing.